And I just wanted to go through something that I get a lot of questions about, especially with what's going on economically throughout the world. Um, Today on the Wall Street, the market was up again, which has a lot of people scratching their heads because, we've got 15 to 20% unemployment right now. And I believe that figure is actually much higher because it isn't really calculating in a lot of the independent contractors and small business owners and their employees. Well, it isn't factoring, it is everyone that's filed for unemployment, but there's a lot of people that didn't file because it's not set up for today's economy where a lot of people are 1099 type employees. I know that in California this last week that supposedly opened up for unemployed benefits, but the early reports that it was just jammed up, that it wasn't easy to get. Then on top of that, California is borrowing billions, like $350 billion just to pay the first round of unemployment. And that could just go on and on. So we don't know where that's going. So a lot of people are asking, where can I put not all of my money, but some of my money so it's at least protected if the COVID situation, coronavirus, if it goes on and on, because we really don't know when it'll be actually behind us. At some point it will, but we don't know when. They could come out tomorrow and say, hey, we've got this under control, all good. And then next month, an outbreak, whatever. So it's going to be touch and go. The economy itself, you could be a very stable company or working for a very stable company. The problem that we've never seen in history is where some other part of the world could be part of your supply chain and just end your business for right now. I mean, or maybe even permanently in certain situations. I think this is going to lead to a lot of good changes, but the pain going forward, maybe the next year, several years, is going to, expose a lot of things that we didn't know. It's going to cause some improvement in a lot of areas as well. So that said, let's talk about a place that has been around forever. And when the market was just running up and setting new records, everybody kind of left to the side because market was doing so good. So now that safety's back, safety's the name of the game. I'm not saying get out of the market completely, but I'm saying there's anybody that wants some safety. And I know, I work with a lot of very, very wealthy people, and they want safety just as much as the next guy. So we're going to look at a traditional place for safety, and it is found in annuities of all places. And sometimes people get a negative thinking around annuities. Annuities have evolved greatly, and they're at a point now, especially when we're in a world with, very, very low interest rates, that annuities are basically like what used to be in the bonds. Like back in the day, you had bonds that were what was used. You'd have stocks and bonds in a portfolio. Now you've got super low interest rates. So instead of taking the interest rate risk in bonds, you can simply use an annuity when it's structured correctly. So with that said, I'm going to have you look at this. This is a report that we give to clients for annuities to look at the difference of a few things. And again, we use them a lot like bonds in the fact that we invest money into equities, and then we use annuities to create some security. If you look here, though, this is since 1999 up to 2018. S&P 500, which, the S&P 500, you can see the returns. I mean, it's down some years, but the years it's up can be way up. And then looking at an annuity, which isn't even designed to do big returns, but what it is designed to do is not lose money. You can see here, even with zeros and only 5% on the best years, it actually beat it from 1999 to 2018. It beat the S&P 500. That's pretty crazy. Just crazy. And that's with only a 5%, what they call a cap on the annuity. So it's the floor is 0, the cap is 5 in this scenario. But the power isn't in the fact that the annuity makes a bunch of money. It's in the fact that it doesn't lose anything. So the next page of this, and I'm going to move really fast through this. So essentially wanted to compare this to a suggested annuity, a 6% steady return, the S&P 500 over the last 20 years, or a 6% return with an unfavorable sequence of returns. And you can see some huge difference. So I'm going to go right to the heart of what, with the yearly breakdown. And you'll see the green is the suggested. You can see it grew to 1.4 the first 10 years. It's putting $1 million in. A steady 6% return actually beat that. It was at 1.6. And the market, this is going back 20 years. So the first 10 years of that 20, it had some negative returns right up front, which dropped the account drastically. And then it had to rebuild, but it only came out to 682. And again, this is not taking any withdrawals. And then you have the unfavorable returns. You had the negative returns up front and so forth, but it's at 794. Then we start taking income. And this is where annuities do something that no other account out there does. And what they do is they keep paying, even if you've spent all the interest and the principal, they guarantee, like a personal pension would do, that the income doesn't stop. But here's what's newer in today's designs. You'll see this client started at 61. At 71, he starts an income, and you'll see it starts out at $97,000 a year, guaranteed, by the way, for life. So if he lived to 100, he's going to receive $97,000 for life every single year. But you'll see that number just keeps increasing. Why? Because the newer annuities actually increase with the index credit. Now, there's only a few companies that do this, but that's super powerful. And it's powerful because of this. Once you attain a new income high level, like where you went from 133 to 147,930, even if the market didn't do anything from that point on, if there was zero return from then on, he would never see a drop in income, no matter how long he lives. Now you see it runs completely out of money at age 84, but it just keeps paying. And it keeps increasing based on the increase. So at the end of, at this case here, 95, that little annuity is paid $4.962 million versus a 6% flat account that, trying to keep up with this one, runs out of money at age 87. So it only paid out 2.4. And then you go into the market-based accounts, and they didn't even pay out the full amount because they didn't have, once they started drawing income, it just wiped the account straight down. And you'll see here, same thing. So you barely got back. Like, the market is amazing when it's going up for money that you're not spending, but it is absolutely atrocious for money that you're going to draw out of. Because think about it. If you have let's say a 20% loss and you're taking out, let's say 5%, that's 25% drop that particular year. And the next year, and the next year, and the next year. I mean, Again, it could just drain the account very quickly, and it often does, where an annuity gives total security. Now, again, we are very comprehensive in planning and work with very high net worth clients. We use these as a balance, and what they do is create the ability to go to Wall Street and actually look for high upside securities, because we've got the downside protected with things like annuities, which have only gotten better over the last 20, 30 years. Annuities used to be one of the worst products out there. Now, because of competition, because of technology, because of all of it, they have actually become very competitive. And when it comes to income, they cannot be beat because they don't lose money. And in essence, you're transferring the risk of interest rate risk, market risk, all that. You're transferring it to a gigantic insurance company instead of assuming it yourself. So what does that mean? It means that just like any other type of insured type of accounts, you're transferring the risk. You're not looking for a home run with the money that you would put into an annuity. What you're looking for is to really create a strong sense of certainty for money that you cannot afford to lose, money that needs to be there to pay the bills month in and month out. Now, I've seen a lot of very wealthy clients that basically, you would laugh if you saw some of what they do, because a lot of them have almost all their money in things like annuities. And you think, well, why are they doing that? Well, they have gotten to where they are and they don't want to go backwards. Now, I don't suggest going all in the market, and I don't suggest all in annuities. What I do suggest is a balanced approach. And in today's very rapidly changing economic world, annuities definitely make sense, and they make 100 times more sense than they did back in February, before we knew what was happening with coronavirus and so forth. So I will say this: people always say, "What's the downsides?" The downside on an annuity is you can't just put money in and take it right back out. A lot of them have what they call surrender charges. They're similar to like used to be like old bank CDs. And typically, to find a decent type of plan these days, you're talking 7 to 10 years is typically the length of a surrender period. Now, you can still get access to the money or to a good percentage of the money through that time, but you do need to be aware it's not something to put money in and then next year take it all out, or you're going to pay a penalty, because the insurance companies having to ensure that income is there, and they're having to hedge. They're taking the risk, not you. So basically, that's a downside to most annuities. There are some that waive. In fact, a lot of them nowadays waive if you're sick or if you die. They waive the surrender charges. And really, in my career, it's usually getting sick or dying that, when you need big amounts of money all at once. So in that case, almost every company out there waives any cost to get out. So in that case, they're very liquid. Only other downside would be that there's so many plans out there. You really need to work with a professional to understand what the options are, because one thing about them, I mean, we as advisors all wish that they would just make some plain Jane accounts, but the rush has been over the last 10, 15 years to make them do all kinds of really cool things, but the complexity went right up with it. So, even as a professional, we have to work like crazy just to stay on top of what's new, what's changed, what's guaranteed, how does it work. So anywho, I hope you got something from this. And again, it's John Duncan. If you have any questions on anything on this or any other issues or anything that I've covered on other videos, simply shoot me an email and I'll be happy to answer it for you. And if you got a question on your situation itself, contact my office, and we'll set up a time to discuss that. Anyway, it's Friday afternoon. I hope you're having a good day, and I'll talk to you soon.